If you receive SSI, there's a number you need to know by heart, and that number is $2,000, because that's the most you're allowed to have in the bank as a single person before your payment can stop. And that number has not changed since 1989. Not last year, not 5 years ago, 1989. Which means something as ordinary as a tax refund landing in your account or a birthday gift from your daughter can push you over that line without you ever meaning to break any rule at all. And here's the part almost nobody tells you. Your bank isn't going to warn you when that happens, because it's not their job to, and Social Security checks your balance in ways most people don't fully understand. Stick with me, because at the end of this video, I'll walk you through one tool that can let you save far more than $2,000 without putting a single payment at risk. Hi, I'm Walter Sinclair, and before we go any further, I want to be upfront with you the way I always am. I'm not a financial advisor. I don't work for the Social Security Administration, and I'm not affiliated with Medicare either. What I do is spend my week going through Social Security updates and public guidance so that you don't have to dig through government websites yourself. And today we're covering a rule that affects millions of people on SSI and causes more accidental payment losses than almost anything else in the entire program. Here's what we're covering. First, exactly what the $2,000 limit means and what counts toward it. Second, how Social Security actually checks your bank balance and how often. Third, the specific timing rule that trips up more people than anything else. Fourth, the most common ways people accidentally go over the limit without doing anything wrong. And fifth, saved for the end, a legal tool that lets certain SSI recipients protect up to $100,000 in savings without losing a dime of their payment. If any part of this applies to you or someone you love, I think you'll want to see this through to the end. If this video helps you, I'd ask one small favor. Consider subscribing, not for my sake, but because I put out a new video like this every week, and if this rule changes, or if Congress ever updates that $2,000 limit, you'll hear about it here. Now let's get into it. Let's start with the basics. SSI stands for Supplemental Security Income, and it's a needs-based program, which means, unlike regular Social Security retirement benefits, it's not just about your age or your work history, it's about your financial need. And because it's needs-based, the program sets a hard limit on what's called your countable resources. $2,000 if you're single, $3,000 if you're married. A resource, in Social Security's terms, is basically anything you own that could be turned into cash and used for food or shelter, which mainly means the balance in your checking and savings accounts, though it can include other things too. Your home doesn't count, one vehicle doesn't count, household goods don't count, but cash sitting in the bank absolutely does. It's also worth being specific about what does and doesn't count, because I hear a lot of confusion here too. Cash, checking accounts, savings accounts, and money market accounts all count toward that $2,000 limit. Stocks and most other financial assets count as well. But there's a shorter list of things that are excluded entirely, no matter how much they're worth. Your primary home, one vehicle, your household goods and personal belongings, a burial plot for you and your immediate family, and up to $1,500 set aside specifically for burial expenses. Knowing this list matters because a lot of people panic unnecessarily about their home or their car counting against them, when in fact, those are protected regardless of value. Now, how does Social Security actually know what's in your account? This is the part most people don't realize. There's a system called AFI, which stands for Access to Financial Institutions, and it allows Social Security to electronically check your bank balances directly with financial institutions across the country, not just in your home state. This isn't a one-time check when you first apply either. It happens periodically throughout the time you receive benefits, during what's called a redetermination, which is simply a scheduled review of your continued eligibility. And here's the uncomfortable truth. You often don't get advance notice of exactly when that check will happen. So if your balance happens to be over the limit at the wrong moment, that's what gets flagged. Which brings us to the third piece. And this is the one detail that trips up more people than any other. Social Security typically looks at your resources as of the very first moment of the calendar month, meaning your balance on the first day is what counts, not your average balance, and not what you had at any other point. So here's a real example of how this plays out. Let's say you have $1,800 in your account most of the month, well under the limit, but a check happens to clear on the first of the month that pushes you up to $2,500, and then you spend it down within the first week paying bills. Under the rules, you were still over the limit on that first day, which can cost you your payment for that entire month, even though you were compliant every other day. That's how tight this margin really is. And it's why simply knowing your balance most of the time isn't enough. You have to know it specifically on the first. Let me tell you about Ruth. Ruth is 74 years old, lives in a small town in Georgia, and has been on SSI for several years after a health condition made it impossible for her to keep working. Ruth is careful with money. She budgets closely, and she genuinely believed she understood the rules. One year, she filed her taxes and received a modest refund, a few $100s, which landed in her account right around the first of the month. At the same time, her monthly SSI payment had just come in a few days earlier and hadn't been fully spent down yet. For that one day, her balance crossed over the $2,000 line, and because Social Security's system checks the first of the month, that single day was enough to flag her account during her next redetermination. Ruth ended up losing an entire month's SSI payment, money she had already planned around for rent and medication, and she had done absolutely nothing wrong in the way most people would think about it. She simply hadn't realized that timing mattered as much as the total amount. What made this hard for Ruth wasn't just the missing check. It was the feeling of being blindsided by a rule she didn't fully understand after being so careful for so long. The resolution came when a caseworker at her local Social Security office walked her through exactly how the first-of-month rule worked and helped her set up a simple habit: checking her balance every single month right before the first, and if it looked like it might be close to the line, paying a bill or two early to bring it down in time. It's a small habit, but it gave Ruth back a sense of control over something that had felt completely out of her hands. Now let's talk about the most common ways people end up over the limit without ever intending to break a rule. A tax refund is one of the biggest, just like we saw with Ruth. A small inheritance is another. Even a modest one from a parent or a spouse can push someone over the line overnight. Well-meaning gifts are another common trigger. A grandchild sending $200 for a birthday, or a family member helping cover a bill, can be enough by itself if your balance was already close to the limit. And one that catches a lot of people off guard: a delayed bill payment, where money you expected to have spent by month's end is still sitting in your account longer than planned, simply because a bill posted late. None of these situations involve anyone doing anything wrong, and that's exactly the point. Social Security's own data has shown that a large share of overpayment cases tied to resource limits happen not because someone was trying to hide money, but because their circumstances changed after they were already approved, and nobody updated their tracking to account for it. There's one more misconception worth clearing up here, because it comes up often. Some people think the solution to all this is simply giving money away right before the first of the month, to a child or a family member, so their own balance looks lower when Social Security checks it. This is riskier than it sounds, because Social Security can treat transfers like that as giving away resources for less than fair value, and that can trigger its own separate penalty, sometimes affecting your eligibility for months afterward. So gifting money away isn't a safe workaround. It just trades one problem for a different one. Now, here's a myth-busting moment I want to spend a minute on, because I hear this confusion constantly. A lot of people assume that all Social Security benefits work this way, that any kind of Social Security payment can be affected by how much you have in the bank. That is not true. SSDI, which stands for Social Security Disability Insurance, is based on your work history, not your financial need, so there is no asset test at all. Your savings can be as high as you want, and it won't affect your SSDI payment. The same goes for regular Social Security retirement benefits and survivor benefits. None of those programs look at your bank account balance in any way. This resource limit we've been discussing applies specifically to SSI, and only SSI. So if you're on SSDI or retirement benefits, this entire video simply doesn't apply to you in the same way. And that distinction matters, because I know a lot of people worry unnecessarily about savings affecting benefits that were never asset tested to begin with. So if you are on SSI, or you help manage finances for someone who is, this margin is real, it's tight, and it's easy to cross without meaning to. But there is a real, legal way to protect far more savings than $2,000, and we're going to cover exactly how that works right after this. I know what some of you are thinking. If this rule really trips up so many people, wouldn't my bank flag it for me before it became a problem? And I understand why that seems like it should be true, but here's the honest answer. Your bank has no obligation to track your SSI eligibility, and frankly, no real reason to, because your bank account is yours, and it's not their job to monitor it against a federal benefits program they're not part of. This isn't a conspiracy, and it isn't your bank hiding something from you. It's simply a gap between two systems that were never designed to talk to each other. The responsibility falls on you, or on whoever helps you manage your finances. And that's exactly why understanding these rules yourself matters so much. I'm not telling you this to scare you. I'm telling you because knowing it in advance is the entire difference between a surprise and a plan. Before we get to the big one, I've put together a simple, free, one-page checklist covering everything in this video. The resource limit, the first-of-month timing rule, and the most common accidental triggers, so you can keep it somewhere handy or share it with a family member who helps you manage your SSI. There's no catch. The link is right there, and it's meant to make this easier to actually use, not just something you watch and forget. Here it is, the tool I promised you at the very start of this video. And for the right person, it's genuinely one of the most powerful protections available in the entire SSI program. It's called an ABLE account. ABLE stands for Achieving a Better Life Experience, and it's a special type of savings account designed specifically for people with disabilities, including many people on SSI. Here's why it matters so much. Money held in a properly set up ABLE account does not count toward your SSI resource limit up to $100,000. Not $2,000, $100,000, sitting safely in an account, completely separate from the resource test we've spent this whole video talking about. To qualify, your disability generally needs to have begun before a certain age, and that age was recently expanded. So if you were told years ago that you didn't qualify because of when your disability started, it's worth checking again, because the rules have changed, and more people qualify now than in the past. You can also contribute new money into the account each year, up to an annual limit that Social Security and the ABLE National Resource Center publish and occasionally adjust. So rather than me giving you a number that might already be out of date by the time you're watching this, I'd point you straight to the ABLE National Resource Center's website for the current year's exact contribution limit. Beyond just protecting savings, an ABLE account isn't a locked vault either. The money in it can actually be used for what are called qualified disability expenses, which is a broad category covering things like housing costs, transportation, education, medical care, and assistive technology. So it's not money you're forced to leave untouched forever. It's money you can actually use for your life while it stays protected from the resource test. Think about what this means in practice. If you're someone like Ruth, who came within a single day of losing a month's payment over a few $100s, an ABLE account could have completely eliminated that risk, because money moved into that account the moment it arrived would never have counted against her $2,000 limit in the first place. For families trying to help a parent or a loved one on SSI build any kind of real financial cushion without constantly worrying about crossing that frozen 1989 number, this is, for many people, the single most valuable thing in this entire video. Let's bring it all together. Number 1. Know your resource limit. $2,000 if you're single, $3,000 if you're married, and remember, it hasn't changed since 1989. Number 2. Understand that Social Security can check your bank balance electronically through the AFI system, at application and periodically afterward, often without advance warning. Number 3. Remember the first-of-month rule. Your balance on day 1 of the month is what counts. so check your account right before the 1st every single month. Number 4. Watch out for common accidental triggers: tax refunds, small inheritances, gifts, and delayed bill payments. And try to spend down or move funds before the 1st if you're close to the line. Number 5. If you or a loved one qualifies, look into an ABLE account because it can protect up to $100,000 without affecting your SSI at all. And number 6. If none of this applies because you're on SSDI or retirement benefits instead of SSI, you can set this particular worry aside entirely because those programs have no asset test. If you know someone on SSI or someone who helps a parent or a family member manage their SSI, please send them this video, because a single missed detail on timing or a single unexpected gift is genuinely all it takes to lose a month's payment. And that's exactly the kind of thing that's easy to prevent once you know about it. I'd love to hear from you in the comments. Had you heard about the ABLE account before today, or is this the first time? Next week, we're going to look at a related topic: the exact tax breaks in the new tax law that are set to expire over the next few years, and what that means for your bottom line. So keep an eye out for that one. Until then, this is Walter Sinclair, reminding you, know your numbers, know your dates, and don't let a rule from 1989 catch you off guard today. I'll see you in the next one.